There's one over here. You want a power outlet? There's one over here. Just take one and pass it back. Just take one and pass it back. Okay, let's get settled in. So last reminders. One is there is class on Monday. I know some of the Tuesday, Thursday classes, this is the last week of class. There is class on Monday, and that class will basically be a class to pull together what you found. It's kind of a review class using what you found on your projects as kind of material for the review. So we'll essentially do the whole class in 80 minutes with what you found on your companies, providing grist for the mill. But to do that, I do need your numbers by Sunday. So when you get the numbers for your company together, I'll resend that summary sheet so you know exactly what I'm talking about. Just plug in the numbers that you found for your company and send it back to me. Please don't add columns, take out rows, because it makes it really difficult for me. Okay? So let me so in today's session, I'd like to do a couple of things. One is I want to kind of complete the mechanics of valuation. And in the process, I want to talk about growth rates and putting closure on the valuation and bringing it all together. And if I get a chance, I'd like to revisit something I talked about last session, which is connecting stories to numbers. In fact, I gave you the single page sheet. This is kind of what I mentioned in the last class about valuing Amazon. I'm going to use the Excel spreadsheet that I sent you to value a company as kind of a vehicle to bring my story about Amazon into the numbers. But let me go back and complete the last piece of the discount rate issue. As I said, much of what we've said about discount rates in corporate finance applies just as much in valuation. The cost of equity is still the cost of equity. The cost of capital is still the cost of capital. The one thing, though, in valuation that you get as an added degree of freedom is when we did capital budgeting, we estimated a cost of capital, and that became our hurdle rate. We used that as our discount rate through the life of the project. When you do valuation, though, I talk a little bit about consistency. And here's what we said about consistency. As you change your company, your inputs have to be consistent with the changes you're making about the company. Let me back up. I don't know how many of you are doing high growth companies, but I'm sure quite a few of you are. So right now, when I look at your company, here's what I'd expect to see. I'd expect to see a high growth rate because you're a high growth company. In terms of risk, should I expect to see high risk or low risk? Usually with high growth companies. I'll probably see high risk. In terms of debt ratios, what should I expect to see right now? You're probably going to have a very low or no debt ratio. So right now, when I compute your cost of capital, you're probably going to have a high cost of equity and a high cost of capital and a high growth rate. You think, so what? On your spreadsheet, tell me what you're doing to your company. So you let your company grow, right, over time. And as you grow over time, you change the growth rate because as the company gets bigger, it gets more difficult for it to grow. So your 20% growth on your spreadsheet becomes a 15, then a 10, then a 5, and then even a 2% growth rate, which is natural. But let's keep this consistent. When you started the game, you told me your company, if it looks like I'm crying, it's because I have allergies. It's nothing to do with your project. I'm not weeping for your project. That'll be next week, you know. But to start the valuation, you told me your company was a high growth company and you gave it a high cost of capital, right? Now as you go through and you get to year 5, year 6, year 7, you're telling me your company is a larger, more stable company. Carry this to its next step. What should happen to its risk as a company as it becomes larger and more profitable? It should probably decrease. What should happen to its debt ratio if the company is borrowing at what it can? It should probably increase. So your cost of capital in year 5 should not look like your cost of capital right now. I am amazed at how often I see discounted cash flow valuations where people act like they're one shot at getting the cost of capital. They get it and they're stuck with that no matter what happens to their company. So you take a high growth company, what do you have? You have a 15% cost of capital, which makes sense in year 1, but it doesn't make sense with your own assumptions in year 5 or year 10. So this is not a big deal for me when I value Disney, because Disney is already a large company, but I'm going to do it anyway, because if I don't do it, I run the risk of being sloppy and forgetting to do it when I need to do it. So in the case of Disney, here's what I did. For the first 5 years, I left the beta what it was. 1.0013. It's pretty close to 1, so I didn't have to move it much, but as I went through time, my beta shifted towards 1. Why 1? Because that's a beta for an average risk company. If I claim that Disney is going to become a mature company in 5 years or 10 years, I would expect its beta to move towards 1. You say, what's the big deal? You move from 1.001 to 1. Here, as I said, it's not a big deal, but let's say you have a company right now with a beta 1.8 or 2.2 or 2.5. Can see the effect it's going to have, right? As I move from 1.8 down to 1, my beta is going to decrease, my cost of equity is going to come down. I can even change my debt ratio and my tax rate, my cost of debt. Every single input in my cost of capital can change. And in the case of Disney, I did make some changes. The debt ratio for the next 5 years, I left at the existing debt ratio of 11.5%. But as I moved towards year 10, I pushed it out not towards 40%, which is what I've found to be the optimal. But given how reluctant Disney seems to be to borrow money, I pushed it only towards 20%. What that does is it changes my debt ratio, and as my debt ratio changes, my cost of capital, which right now is 7.81%, is dropping to 7.29%. Yes?
We have a company that has a beta of 0.9.
Yeah.
And should we, in year 10, go towards...
That's a good question. Is 1 a fixed rule that every company has moved towards? No, actually I'm going to give you a range for your year 10 beta. It's between 0.8 and 1.2 is the range. The way I come up with that range is 67% of all US companies fall between 0.8 and 1.2. So I'm saying at least be in that middle band, don't have a beta 1.6 or 0.4 in stable growth, because then you're telling me your company is a mature company, but you're not giving it the risk characteristics of a mature company. I'll give you a rough sense of whether you're even on the right track with your cost of capital in your terminal year. You know what the median cost of capital for a US company in 2015 was? Across all 8,000 US companies. If I computed the cost of capital for all 8,000 and I put up a distribution, what do you think the median cost of capital is right now? You have all the ammunition need to think. So think through the risk-free rate, risk premiums, debt ratio, cost of debt for a median company. What do you think that number looks like right now? 7.5. It's actually pretty close. It's about 7% is the cost of capital for a median company, because the reason being that if you think about a median company having a beta of 1, that gives you a cost of equity of about 8%, right? But then you have a debt ratio of, let's say, 20%, which is the median company's debt ratio, and a cost of debt, even generously, if I put it up at 3.5%, my cost of capital for a mature US company that gets a bulk of its business in mature markets is 7%. You see why that's useful? Because when you do your valuation, if you look at your terminal year and you see a cost of capital of 10, 11, 12%, you're either working in a higher inflation currency, in which case it's fine, or you're working with a company with an extraordinary amount of emerging market operations, in which case it's fine. But if you're looking at a Coca-Cola, or you're looking at even a Google with the bulk of its operation in the US 10 years out, you shouldn't expect to see cost of capital of 10 or 11 or 12% because that doesn't make sense in US dollar terms in the market we're in right now. So what I'm doing is I'm opening the door to the possibility that when you look at your company and you try to come up with the cost of capital, you have the freedom to revisit that number every year. And I think it gives you a lot more flexibility. It gives you flexibility because you don't have to be right off the top because you get a chance to readjust those numbers. It actually allows you also to deal with one very common problem that analysts run into, which is when they value companies, and this happens in investment banks, it happens in consulting firms. One of the big debates that analysts get involved in is, should I value the company using its actual debt ratio or its target debt ratio? You say, what does that even mean? Well, presumably there's some number you have in your head as to what this company should have, an industry average and optimal, right? And you can see the values you can get can be very different, right? Because if you use 11.5% for Disney as your debt ratio, the value per share that you can get can be very different from 40%. I've given you a way in which you can split the difference because right now your debt ratio is 11.5%. What you and I think about the target is irrelevant because the company right now is 11.5. If you feel your company is going to move towards the target over the next 10 years, it better be more than a feeling first, right? Maybe the managers have given an inclination they're going to increase the debt ratio. Then here's what you can do. Give me the target, let's say it's 30%, and I will move your debt ratio from 11.5 to 30% over the next 10 years, and the cost of capital will adjust. So you can have your cake and eat it too. You can value the firm using the current debt ratio, which is realistic, but you can also adjust the cost of capital for that shift towards that optimal debt ratio or target debt ratio. Any questions on the cost of capital? Yes?
How do you decide how much you change each year?
Well, by the time I get to, how much I change each year. Let's say I'm at 10 and I want to get to 30 in 10 years. This is going to be simplistic, but humor me. I could sit there and try to guess what year 1 is going to be and year 2 is going to be and year 3 is going to be, but the reality is I have no idea, right? So if I want to get from 10 to 30 and I have 10 years to do it, and you want your spreadsheet to do it for you, you know what you should do? Just take the 20, divide by 10, go 10, 12, 14. Don't try to get too fancy with the year-to-year numbers. The reality is, if your target number is a reasonable number, how you get from 10 to 30 is going to have very little effect on your valuation. The 30 will have an effect. So in fact, I'll make that general point about any number you're changing over time. Let's say your margins right now are 5%. You want to get them to 10% in 5 years. Go 5, 6, 7, 8, 9, 10. You're done. Don't put log exponential functions. Don't try to tweak the numbers because it's really not worth the trouble. So in fact, that's what I'm going to do with any number that changes. I'm going to make linear adjustments so it makes my life easy, and it also means I'm not sitting there saying, what will the year 3 number look like? Because I really don't know. If you have a clear idea that maybe much of the change is going to happen in the first year, then fine, you can make that change. But if you don't, just set it up as linear adjustments. Any other questions? Yes? Cost of equity is always based on the levered beta. And the cost of debt is not changing either, right? You know why? Because the year 6 Disney is very different from the year 0 Disney. You're assuming that the business mix for the company you see today, you're assuming the unlevered beta doesn't change over time. That too is going to change, right? I mean, in a sense, you've got to almost throw up your hands and say, the unlevered beta is changing, the debt ratio is changing, the size of the firm is changing, my operating income is changing, I have no idea how they're changing. So rather than focus on trying to make this a precise number by keeping the unlevered beta fixed, that's false precision because the unlevered beta is not going to be fixed. So what I'm saying is these numbers are all pushing in different directions. I have an end number and I have a starting number. In fact, in the Excel spreadsheet, I don't even go through the beta adjustment. I ask you for a starting cost of capital. The initial cost of capital, which is today's cost of capital, you give me a number, right? And that's based on the bottom-up beta. You did all the converting leases to debt. All that work went in. You said 8.57%. You know what I then do? The cost of capital for a mature company in the spreadsheet is actually set at risk-free rate plus 5%. Why 5%? Because roughly speaking, with today's risk premiums, that's what it works out to. So here's what I do. I have a starting number, 8.51%. Let's say you're doing a valuation in US dollars. Right now, the risk-free rate is 2% roughly. 2 plus 5 is 7. In the spreadsheet, here's what happens. I start with 8.5. I keep it at 8.51. If you want to put in 4 decimal points, I leave all 4 for the next 5 years. And then I get to year 5, and here's what I start doing. I start moving from the 8.51 to 7%. I don't even bother breaking it down to betas and debt ratios because it's really not worth the trouble anymore. So sometimes, especially in valuation, it's good to kind of let go of those specifics on the cost of capital because it's not helping you that much from a perspective of valuation. So you're right, my unlevered beta might be changing, my interest coverage ratio is changing, and I'm throwing up my hand saying, I don't know what the actual precise numbers are going to be, but I do know what the cost of capital should look like for a mature company. Any other questions? Yes? It cannot be assigned until you tell me your company is a mature company. It doesn't have to be year 10. It could be today. So if you tell me your company is Toyota and you tell me your company is a mature company today, I'm going to ignore everything you told me about cost of capital and try to make it as close to 7% as I can. So it doesn't have to be year 10. In here it's year 10 because that's when I'm making the company a mature company, but it could be year 5, year 3, year 2, or year 1. Okay. So discount rates, cash flows. Up to now, we're actually on fairly comfortable ground if you're an analyst because you have the comfort of numbers backing you up. Right? So when I ask you, where did the cash flow come from? You pull up last year's 10K. When I ask you, where did your cost of capital come from? You do the bottom-up beta. You show me the debt-to-equity ratio. In other words, every number you can back up with another number. Now it's a third input in valuation where you have to leave your comfort zone. Because here's what I'm going to ask you. What's the future going to look like? And already your discomfort starts to rise because I'm asking you to play God. So when you think about growth, people start to get really nervous because I don't know. You don't have to know. All I'm asking you is, what do you expect? All I'm asking of you is that you look at the information you have, what you know about the company, and tell me what your best estimate is for future growth. In making this estimate, though, I'm going to put some bounds. See, you know what I mean by bounds? Basically, if I let you use whatever growth rate you feel like using, any company can be worth any amount of money. And here's the bound I'm going to put on your growth rate. To grow, I can't endow companies with high growth. Growth has to be earned. And to understand what drives growth, I'm going to go back to 2 very basic questions. How much are you reinvesting? Do you see why that question matters? Because if you're going to grow, you've got to put money back. That's a question we answered with that reinvestment rate we computed last session. And then I'm going to ask a second question. How well are you reinvesting? Algebraically, if you're in steady state as a company, here's what your growth rate is going to be. It's not what you and I think it should be. It's going to be a product of 2 numbers. If I'm looking at net income growth, the 2 numbers will be what percentage of my net income I'm putting back into the company, what I'm reinvesting back, times the return on equity. And if I'm looking at operating income, it's going to be the product of that reinvestment rate. If you remember the net capex and change in working capital as a percentage of after-tax operating income, for Disney it was 53%, times what you earn as a return on capital. So let's be simplistic. Let's suppose you're a company that reinvests 80% of your earnings back and you earn a 20% return on capital. Your expected growth rate is going to be 80% times 20%, which is a 16% growth rate. Even if you don't buy into the equations, it forces you to be disciplined when you think about growth. So when you want higher growth, here's the question you need to ask yourself. What's going to change at this company? Are you going to reinvest more or are you going to reinvest better? Because it's got to come from one of those 2 things changing that's allowing you to grow faster. So let's take our companies and back out the growth rates. As I said, I'm going to value Deutsche, I'm going to value Vale, I'm going to value Disney, and with each of these I have to make an estimate of growth. Let me start with Deutsche Bank. I'm going to go back to simpler times, January 2008, when banks were banks and dividend discount models could be used. And if you remember, I said I'm going to value Deutsche using a traditional dividend discount model. To estimate the growth, here's what I did. I first computed the return on equity, the same way we computed return on equity for corporate finance, net income divided by book equity, which presumably you already have for your company. And for Deutsche in 2008, that number was 19.45%. It was a really good year, 2007. And if you looked at the reinvestment rate, Based on 2007 numbers, they reinvested about 67% of their net income back into the business. Let me pause right there. Those are 2007 numbers. Return on equity looks really good. Retention ratio looks really good. Really good number times really good number gives me a really good number. I get a growth rate of 13.04% at the start of 2008 if I assume that 2007 numbers are the numbers I will earn in the future. You see why it's an if? Because I know in early 2008 that I'm looking at a really good year. And some of you will face the same scenario. When you value a company, you can look at the most recent year, which is what most of you are looking at. That year could be a really good year, a really bad year, or an average year. It's very dangerous to base a valuation on 1 year's numbers. The solution is actually pretty trivial here. What I did was I looked at the average numbers from 2003 to 2007. The average return on equity, rather than 19.45%, is 11.81%. The average retention ratio is about 46%. When I valued Deutsche at the start of 2008, rather than use 2007 numbers, I used those average numbers. 45.72% times 11.81% gives me a growth rate of 5.4%, which is what I built into my valuation at the start of 2008. I'm trying to short circuit a question some of you are going to have when you sit down and plug numbers for your company. You're going to get some strange numbers from 2013 or whatever your most recent year was, or 2014. Some of you might have really high returns on capital. Some of you might have negative reinvestment rates. You're saying, what does that mean? In 2014, you might have actually had more depreciation than CapEx. You didn't reinvest any money. If you stay with those 2014 numbers, you will get strange looking growth rates, but you don't have to. There are no rules in valuation. There are only exceptions. Every company is an exception, and it's your judgment to make as to what those numbers will look like in the future. And that's what you're trying to do when you're trying to estimate growth is, what will my company make in a normal year as a return on capital? What will it reinvest in a normal year? And that's a tougher call than it looks, especially when you have companies where the earnings go up and down and the reinvestment changes every year. Any questions though about the intuition of what we're going to do, what we're doing? So to grow at a high rate, a company has to reinvest a lot and reinvest well at the same time. And that's really tough to do. Yes?
For a normalized return on equity, so you're averaging out the net income over the period, but why are you not also averaging out?
Because you want to average out numbers that jump around. See, that's so when I do free cash flow to equity, for instance, the net income jumps around, but if the CapEx is pretty stable, I don't have to normalize it. Because I'd actually prefer updated numbers if I could. So if I have inflation affecting my CapEx, I'd like to use the most recent year's numbers. So if a number doesn't jump around, there's no need to normalize it. Right? So that's why it's a judgment call that you might have to make. If my invested capital also jumped around for whatever reason, my book equity, then I would be more inclined to average that as well. Right? Any other questions? Yes?
Why aren't they considering buybacks?
That's a good question. It's Deutsche. They don't do buybacks. If this was JP Morgan, did everybody get the question? Which is, I'm just looking at just dividends. And it's a good question. If I'm returning half my money in the form of buybacks, then it's clear that it's not going back into the company for future growth. I should be looking at the total amount returned. Note a caution though, if you decide to add buybacks back, you definitely have to normalize. Think of why. Dividends are pretty stable. I don't have to normalize dividends. But buybacks tend to jump around. So you got to be careful about not using last year's buybacks as the proxy for what the company will buy back every year. So that's Deutsche. Let's turn to Tata Motors. Right? I actually showed you this table earlier when we did the free cash flow to equity. And in that table I computed how much the equity reinvestment was each year that the company made. And over the 5 years, the reinvestment rate, the equity reinvestment rate was about 88%. For every $100 of net income coming in, I'm putting back $88. So you say, why aren't you using dividends for Tata Motors? If you can do the actual cash flows, why trust dividends? We know companies sometimes pay too much in dividends and too little in dividends. Focus on what the company is actually doing. It has a net CapEx and the change in working capital. So the reinvestment rate is 88%. I'm normalizing because the numbers tend to jump around. Then I got to return equity. And here, if you look at the book equity, you see why I had to normalize? because they bought Jaguar Land Rover right in the middle. Their book equity jumped. If I don't normalize, I'm going to get some strange looking numbers. So here, in fact, I normalized. And the way I normalize actually is I just add up the 5 years of numbers. It's the same as averaging, but it's just the aggregate net income divided by aggregate book equity gives me a return equity of 43%. I actually was a little distrustful of that number. You know why? It's an automobile business. It's an automobile company. And if you look at the valuation spreadsheet I sent you, there is actually an industry average, both US and global industry averages. The reason I put that in there is when you compute the numbers for your company and you look at that and say, can I trust this number? Does this number make sense? One of the most obvious things to check it against is, what's the industry average? So if you have a company with a 50% margin where everybody else makes 11% margins, you've got to stop and ask, is this so special that it can really make 50% margins, or they're playing with the numbers? In this case, the 43%, if I took it at face value, would give me this an extraordinarily high expected growth rate of 38%. If I replace it with the 2013 value, I still get a 24% growth rate, but it's being driven by that incredibly high return on equity going with the reinvestment rate. There's actually a third column I could open up. So this is the most recent year's number. This is the average number. You know what the third column could be? I could just look at industry averages for both numbers and say, you know what? I can't trust any of these numbers because this company's gone through turmoil. It's done the acquisition. The numbers look off. I'm going to replace the company's numbers with industry averages for both. You're saying, am I allowed to do that? Remember what I said. Valuation, there are no rules. You are allowed to do whatever you want. That's the good news. You know what the bad news is? You're allowed to do whatever you want. Sometimes you wish there were more constraints on what you can not do, but it depends on your company. In some companies, you're probably better off replacing your numbers with industry averages and doing your valuation. Yep.
So for recently public companies, if you don't have historicals, you use industry averages?
Ultimately, what's your objective with every company? Make your best estimates for the future, right? The only reason history helps you is it might give you a starting point. So if you have a young company, you might not have a long history, but you'll still have a history. The question is, do you want to take that 1 or 2 year history and make that your forecast for the future? Do you want to replace with industry average? Do you want to go with an intermediate number? So if you're doing LinkedIn, for instance, as your company, you might not want to take the most recent year. You might not want to move them to industry averages either, because they're growing much faster. You might have selectively some numbers, you might move them towards industry average margins over 5 years, but you might use their revenue growth rate to drive it. So it doesn't have to be all or nothing. Each number you get to stop and ask, for this number, do I want to use last year's number, an average number, an industry average? And guess what? The answer can be different for each input into a valuation, because the end game is you want to make your best estimates for the future. So in this case, basically, depending on whether I use last year's numbers or normalized numbers, I get very different growth rates for Tata Motors. So if you step back and look at what's driving growth in equity income, it's that return equity number, right? To have high growth or high quality growth, I want a high return equity. There are two ways you can end up with a high return equity. One is to go out and pick great projects. That's how Google ends up with a high return equity. Apple ends up with a high return equity. You know what the other way is? Talk to any real estate person, they'll tell you a second way to get a high return equity, which is borrow money and lever up your transactions. How does that help me? It's very simple algebra. If you think about what happens when you borrow money, your after-tax cost of debt is 3, 4, 4.5%, right? So if you make 10% on your projects and you can borrow money at 4%, you as the equity investor get to keep the difference. In fact, again, algebraically, this is always true, that the return equity for a project or a company can be written as the return on capital, which is what this company's return on equity would have looked like as an all-equity funded company, plus the leverage effect. And the leverage effect is basically your debt-to-equity ratio, which tells me how much you borrowed and how much of a benefit you get by borrowing money. So I can take a project which has a 9% return on capital and make the return equity 30, 50, 80, or even 150%. Sounds like too good to be true, right? What's the flip side, though? If you think about pushing up your return equity, You can either take great projects or you can take leverage. Let's suppose you are looking at a company with a 15% return on capital and a book debt to equity ratio of 100%. Right? This has to be booked because I'm looking at return equity as a book number. What's its expected growth rate going to be using the equation from the previous page? Oh, I'm sorry, what's the return? So basically I've given you the return on capital of 15%, 5% after tax cost of debt, book debt to equity of 100%. Let's work out the benefit I'm getting as the equity investor from borrowing money. I borrow money at 5% and I make 15%, right? So for every dollar I borrow, I'm making a 10% differential that comes back to me. My return on equity here, if you go back and plug numbers in, is 10%, 15% is my return on capital. Debt to equity ratio is 1. The number inside the brackets is 15 minus 5. My return on equity is going to be 25%. You see how it's 25%? I've taken the 15%, and because I borrow money, dollar for debt for every dollar of equity, and I'm getting a 10% differential, my return on equity is going to get pumped up to 25%. And my return on equity goes up, my growth in earnings per share goes up, right? My growth in earnings per share goes up. Does my value of equity go up? If it did, I've created magic for you to be able to increase the value of your equity, right? Just go borrow more and more money. Your return on equity is going to get pumped up. Your return on equity gets pumped up, growth in earnings per share goes up. But if I am borrowing money to pump up my return on equity, what else is changing? My risk, captured in my cost of equity through my, how do we get cost of equity? It's risk-free rate plus beta times equity risk premium, right? As I borrow more money, guess what happens to my beta? It gets pushed up as well. So if you're looking at two companies with the same return on equity, 25%, look below that number. If one company is getting to the 25% return on equity by using huge amounts of debt, and the other company is getting to that 25% return on equity by taking great projects, you should expect the company that got to 25% with great projects to be priced higher, valued more highly than the company that borrowed money. But the only way that will happen is we adjust the beta for the leverage. And that's why we make such a big deal about adjusting cost of equity for how much you borrow, because if you don't, you're going to end up overvaluing companies with a lot of leverage. Okay? Any questions on return equity? Now let's try this for operating income. For Disney, I'm going to value the company. So to get the return to get the growth in operating income, I first looked at the reinvestment rate. Rather than the equity reinvestment rate, I looked at the percentage of after-tax operating income, which is the $10,032 net of taxes, percentage of, which is going back into net capex, which is the $3,629, and the working capital. The reinvestment rate was 54%. Here I didn't normalize, and the reason I didn't normalize, I went back and looked over time, and the 54% looked like it was a number that stood up to the test of time. So you don't have to normalize if last year's numbers look okay. For the return on capital, I actually used the same number I used about 10 sessions ago when I looked at the EVA and the value created by Disney. Its return on capital is 12.61%, after-tax operating income divided by invested capital. Here again, I did not have to normalize because the number did not look unusually high or low. So in this case, if you ask me what the growth rate for Disney is going to be, 54% of 12.61% gives me an expected growth rate of 6.8%. In my valuation of Disney, that's what you're going to see as my expected growth rate is the product of how much they reinvest and how well they reinvest. And it's going to be my defense, because if I present this to Disney's managers, you know what they want me to use, right? A higher growth rate. Every manager does. To which my response is, tell me what's going to change. Are you going to reinvest more or reinvest better? Because without changing those two numbers, I can't just give you a 9% growth rate or 11% growth rate. It's a good way of making sure that your valuation is grounded in your own numbers. Okay? Doesn't mean you can't use a higher growth rate. It just means you've got to justify where that higher growth is coming from. Okay? One final scenario for growth, and this is the scenario that's in your spreadsheet that I sent you. I'm going to give you the freedom to actually set revenue growth first and then tell me what will happen to your margins over time. You can take the default and say, I'm going to set revenue growth at my historical revenue growth and my margin at the existing margin, which means you're going to revert back to what I did for Disney and Tata Motors and Deutsche, which is keep things as they are. But I want to give you that freedom because for some of your companies like LinkedIn, a young growth company, I can't keep the margins at today's levels. I've got to adjust them over time. So in this case, there are 3 steps to the process. First, you've got to forecast revenue growth for your company. What's that going to be based on? It's going to be based on the size of your company, the potential market, what you see as the market. And I'll go through this process in a little more specifics in a few minutes. But basically, that's the first step. Second, I'm going to ask you, what kind of margin do you expect to see this company have 10 years out? If your company is a mature company, you might say, I'm going to leave the margin at today's level. If your company is a company where margins shift over time, you might leave it at the average margin over the last 5 years. If it's a young company, you might set the industry margin as your target. You have the choice to make for your company. And then I'm going to ask you a third question. We know that to grow, you need to reinvest. The number I'm going to ask you to estimate how much you need to reinvest is called a sales to capital ratio. Saying what is that? That's revenues divided by invested capital. So if you tell me your sales to capital ratio is 2, for every $2 of revenues, I'm going to make you invest $1 in capital. If you tell me it's 5, for every $5 in revenues, I'm going to make you invest $1 in capital. You're saying, where am I going to get that number? You can look at your own company. You can look at industry averages. In fact, in the spreadsheet, I give you your company sales to capital ratio, the industry averages in the US, global industry averages. You get to decide for your company. And remember, the higher that number, the more efficiently you're delivering growth. The lower that number, the more difficult it is in the sector to deliver growth. Because you get lots of sales for $1 of capital, it means you're going to be able to grow faster with less to reinvest. So you have 3 levers I'm going to let you control. Your revenue growth lever will let you make your small company to a big company. Your target margin lever will make your money-losing company into a money-making company. The sales to capital level will tell me how efficiently you think your company will deliver growth. And with those 3 levers, you can value any company. Okay? In fact, before I even show you the numbers, let me give you a very simple example. You can help me. Let's try to value Uber, right? Uber's revenues right now. You know how Uber makes money, right? How does Uber make money? You get into a car. Does Uber own that car? No, Uber doesn't own the car, so you're the Uber driver. Do I pay you when I get out of the car? Everybody here has taken Uber, right? You're not 65-year-olds with flip phones. Hey, that's the only audience left that doesn't know what Uber is, right? So your credit card is on file. So basically, what you have to pay for the car is already in there. And let's say you pay $20 for an Uber ride. They take 20%, though that slice is not necessarily going to be fixed, right? So in LA, where they have a lot more competition, where Lyft is actually offering drivers all of the ride fare if they drive for more than 40 hours, Uber is having to settle for 15% instead of 20%. So they take a slice of what you pay. So if you wanted to value Uber and you were thinking about revenue growth, right now they have about $1.5 billion, $2 billion. That's just their slice of the revenue. So that's what their revenue is. So if I wanted to figure out what their growth is going to be in the future, I have to make 2 judgments. One is, what business is Uber in? You tell me, what business is it in? Because the answer you give me will already tell me what kind of value you're going to arrive at for Uber. What kind of business is Uber in? What is it? What did you say?
Simply they coordinate the ride.
Coordination. So Airbnb. So that's too. Let's say that's too broad, right? Because Airbnb is also coordination business. That's actually they're using excess capacity elsewhere. But in terms of business right now, for most of us, they're in the car service business, right? If you tell me Uber is a car service company, then your potential market is about $100 billion. Why? Because that is the global taxi, cab, limo, car service market. That's a total market. Uber doesn't call themselves a car service company because if the potential market is only $100 billion, you can't be worth 35, 40, 45 billion. Your value is going to be as a company about 10 billion. If you call yourself a logistics company instead of a car service company, but you know what the difference is? Logistics is any time you have to move items, people from point A to point B, you're involved. So you're now saying your business is not just car service, it could be moving, it could be rental cars, you expand your business, your potential market becomes 300 billion. If your potential market is 300 billion, you could be worth 25, 30, 35 billion. So with young companies, actually getting that revenue growth is very much a function of the story you're telling me about the company. If your story for Uber is it's a car service company, the value that you get will reflect that. It'll reflect the market for the car service business, the margins in the car service business, the market share will be in that business, the value is going to be driven by that business. But if you tell me it's a transportation company or a logistics company, the potential market gets bigger. And if you give them even a 10% market share of that much bigger market, they could be worth a lot more money. That's what I mean about the levers being under your control. And if we get big differences in value for Uber, it's not because your numbers are different from mine, it's because your story for Uber is different from mine. So keep that in mind as we work through this, because I valued Baidu using those three levers. Baidu's revenues right now are about 28.8 billion. By year 10, I'm giving them revenues of 155 billion. How does Baidu make money? It's online advertising. So when I look at the 155 billion, what's the question I need to ask? What's the size of the entire market? How much of that market am I giving them? That's a huge market that I'm giving them. So already I'm telling you the story that I'm telling for Baidu is China online is going to expand. Baidu is going to be able to maintain its monopoly market share and walk away with a big chunk of the Chinese market. You're saying that's wrong, I disagree? That's fine. Because you know how that will show up? Your revenue growth will be lower than mine. If you say, I don't think they can get to 155 billion. I think Google's going to have to be allowed to come into China, which might mean that the revenues that you see for Baidu 10 years out are going to be 50 billion rather than 150 billion. Use a lower revenue growth rate. This is not just a number. The number's got to be backed up by a story. And what I'm asking you to do is start thinking about your company and the markets it is in. Because that's going to drive what kind of revenue growth you attach for the company. Let's take LinkedIn. What are the two ways LinkedIn makes money? Actually, three. One is it connects, it's like an employment, right? I don't know whether they collect, do they make any money when somebody gets a job? I should check this out. Pay for post. So basically it's a classified job ad market, so that's one. The second segment is advertising, and the third is actually subscription revenues, right? Because you can get that premium LinkedIn membership. So if I ask you what value you're going to attach to LinkedIn, the first question you got to address is, where do I see them going in the future? Primarily subscription-driven business, a primarily advertising business, or a primarily a job search business? Three, or maybe they'll do all three. And when you think about revenue growth, you got to think about the potential size of these markets and what do you think LinkedIn will have of that market. So that's a revenue growth number. Your revenues will reflect what you think about the company's potential market. And the market share that you see your company capturing. What's going to drive that market share judgment? Have you heard of networking benefits? I mean, this is when people talk about networking benefits, what are they talking about? The fact that if you become large as a company, it becomes even easier for you to become larger, which for me, from a valuation perspective, is something you're saying about market share. Again, I'll use Uber to bring home this point. When I did my initial valuation of Uber, the assumption I made was it's an urban car sharing company, so that kept the potential market at 100 billion, with local networking benefits. You know what that means? If they become the biggest service in New York, then they'll continue to be the biggest service, because when you look at your phone, an Uber car is always going to be 2 minutes away, a Lyft car is going to be 15 minutes away, so it becomes easier for you to get a higher market share. But I assume to be local networking benefits. What I mean by that is if you land in Jakarta, you're not going to pick the largest car service company in the world because you want a car service in Jakarta. So you're going to pick whoever the largest car service company in Jakarta is, and it might be one of the Chinese car sharing companies. You know how that played out? The market share I gave Uber in steady state was 10% of the global car service market. What's 10% of 100 billion? It's about 10 billion. If you let it grow, it's about... So basically, that determined the revenues I gave Uber. Bill Gurley, who was the venture capitalist, one of the lead venture capitalists at Uber, countered and he said, no, I think Uber has global networking benefits. And he gave me a pretty sensible story. He said, no, we're connecting up with credit card companies and with the airlines. And what that's going to allow us to do is when you land in Jakarta, because Uber is connected already to a credit card and your airline already has a connection, it's going to be more likely that you will take Uber in Jakarta even though it's a... So it's a story about what he thinks the market share is going to be in the future. And if his story is right, the market share could be 40% rather than 10%. A very different valuation even given the same market. But that's driving your revenue growth. For Baidu to get the margins, their existing margin is astronomically high. It's an advertising company. It gets to keep almost all of its money. 48.72%. That number actually lowered over time because my view is as the market gets bigger, it is going to get more competitive because you're going to now be competing against the Facebooks of the world and the Alibabas of the world. So you got to kind of bring your costs down. So what you're seeing actually is a decline in margins over time. Again, a narrative I'm telling about. So what I'm essentially telling about Baidu, it's going to get much bigger, but its margins will have to decrease as a consequence. Their tax rate, which is 16.31% today, is an effective tax rate. But over time, I've pushed it out to 25%, which is the marginal tax rate in China, assuming that over time, your taxes will start to catch up. Now, that doesn't have to be. You could have a U.S. company where you leave the tax rates below 40%, even in steady state, because as a global company, you might assume that the tax laws will change over time. And when that happens, Apple's not going to be paying 40%. It's going to be paying closer to 28 or 29 or 30%. But it's a judgment call you got to make. Now here comes a reinvestment number. For every $2.64 in sales, I'm going to assume that Baidu has to invest $1 in capital. That's actually their existing sales to capital ratio. So I took their total revenues divided by total invested capital today. The same invested capital I use for the return on capital. And it's 2.64. And the way it plays out is if you look at year one, my revenues go from 28.8 to 35.9 billion, right? So that's an increase of about 7 point something billion. You divide that by 2.64. There's my reinvestment in year one. So capex, depreciation, working capital are all in that number. I've kind of consolidated all those reinvestment numbers into a single number, and I do that every year. It's simplistic, and you have to stay simple with high growth companies because you really can't take last year's capex and working capital and try to build too much of it because there's not much there right now. So that's my reinvestment. So if I take my after-tax EBIT minus the reinvestment, I come up with the free cash flow to the firm every year. And notice the free cash flow to the firm goes from 11.5 billion to 38.5 billion over the next 10 years. Partly because my revenues are exploding out, and partly as my growth decreases, my reinvestment starts to drop off. So lower growth ultimately is what push up my cash flows, and it shows up in those cash flows in the final year. Revenue growth, target margin, sales to capital ratio. Those are the numbers that will give me future free cash flows of the firm. So let's review where we are. You've got cash flows, which can either be to equity investors to the firm. You can have a discount rate, which can again either be to equity investors to the firm. And your growth rate has to be tied to things your company does, the markets and what you believe about your company in the future. Which brings me to the final piece of valuation. The value of any asset is the present value of its expected cash flows over its life. That's true for any asset, right? So if I give you a rental building with a 10-year life, you take the cash flows in the next 10 years, you discount them back, you get a value for the asset. If you extend that principle, the value of a company is the present value of its cash flows over its life. But a company's life essentially could be forever. So when you value a company, one of the questions you always face is, what do I do when I get to year 10 or year 15 and I'm tired of estimating cash flows? And you want to stop. In other words, how do you put closure on a valuation when your cash flows can keep going forever? And the way we put closure on a discounted cash flow valuation is we stop estimating cash flows at some point in time and we estimate what we generically call a terminal value, which we did for projects as well, right? The terminal value is what I think your business will be worth 10 years out or 20 years out. if you want to stay consistent with this being an intrinsic valuation, remember we said there are two ways to think about an asset. You can do an intrinsic valuation or a pricing. If you want to keep this an intrinsic valuation, there is unfortunately only one way in which you can estimate the terminal value, which is to assume that at some point in time in the future, your cash flows will grow at a constant rate forever. So the minute you make that assumption, I can use this equation to come up with the terminal value. The reason I'm saying that is if you look at most DCF valuations in banks, you know how the terminal value is computed? By applying a multiple. And what's a multiple doing? It's applying a pricing. These are neither fish nor fowl. They look like discounted. I call them discounted cash flow valuations in drag. Or Trojan horse discounted cash flow valuations. Remember the legend of the Trojan horse? Which is, or the Greeks, or I don't know which ones, they brought this wooden horse in, it was a gift, and then inside the horse there were soldiers who came out in the middle of the night, and the rest is history. These are Trojan horse valuations because it looks like a DCF, right? There's all those cash flows, and just as I'm being distracted by those cash flows, what do? You slip in 8 times EBITDA into your 10 number to come up with your term. If you're going to do a pricing, do a pricing. If you're going to do an intrinsic valuation, do an intrinsic valuation. And the intrinsic valuation approach requires that you assume cash flows continue, that you make assumptions about growth and risk, even though you feel uncomfortable doing it because you're saying forever, it's such a long time. You're right, it's such a long time. You have to do it to kind of put closure. That's what allows you to get the terminal value. So what I'd like to actually do is talk a little bit about that terminal value number, because in all of your DCF valuations, every single one of you, this is going to be a big chunk of your valuation. How much? 60, 80, 90, even 110% of your value can come from terminal value. So one of the first questions to look at is, when will I put my company into stable growth? There's no one answer that's going to fit every company. Here are some things you might want to look at, right? First is, look at the size of your firm relative to the market that it serves. If your company is a large company in a mature market, don't wait too long. Your company might already be a stable growth company. That's why I use the example of Toyota. If you ask me, when will Toyota be a stable growth company, my answer is already is. If you ask me, when will ExxonMobil be a stable growth company, so what are you waiting for? These are large companies in mature markets. If you're a small company in a large market, you get a lot more freedom to allow the company to grow, right? So if I look at LinkedIn, I can give it high growth because it's not going to become the market if I let it grow at 30% a year for the next 10 years. If I look at Whole Foods or Sprouts and I try to value them right now, I can give them a high growth rate because they're in this huge market, the grocery market, and they're still relatively small players in the market. So look at the size of your company relative to the market that it serves. And I'm asking you to think about your company now, not about the companies I'm naming. Think about your company and the market that it serves. Second, look at how quickly it's growing right now. And don't look at earnings growth. It's very misleading. Look at revenue growth. If your company's revenue growth has settled in at 2 to 3% for the last 5 years, I would suggest to you that you don't have much high growth left, that this is now a pretty mature company. And revenue growth is the leading variable. Earnings growth actually takes longer to show that. So look at the top line growth, because if top line growth is low, you're probably closer. It doesn't have to be a mature company, but you're closer to being a mature company. And there's a third factor to consider. We talked about growth, right? Growth is a function of how much you reinvest and how well you reinvest. Let me add to that proposition. Growth by itself has no value if you earn exactly your cost of capital. And that's no mystery. When you earn exactly your cost of capital, when I do a capital budgeting project and I assume the return on capital in the project is equal to the cost of capital, what kind of net present value should I expect to see for that project? It's going to be 0, right? And what happens when you take a project with a net present value of 0? What happens to your value as a company? Nothing. What if I take 100 projects with a net present value of 0? Still nothing. 1,000 projects, still nothing. So for growth to be worth money, I've got to earn more than my cost of capital. And if you go back, one of the sections, earlier sections, asked you whether your company makes more than its cost of capital. And if so, I asked, how sustainable is that number? You say, why is he even asking these stupid questions? You see why I had to ask that leading question? Because if you told me in section 5 that your company barely makes its cost of capital, when I get to this stage I'm saying, why are you wasting your time even thinking about growth? There's no value to growth. If you tell me your company is making more than its cost of capital, but you don't think it's sustainable, why? Because competition is coming in, the market is changing, then I'm not going to waste my time putting in a 10-year growth period, because what's the 10 years of growth going to do for you if you're not earning more than your cost of capital? But if you told me at that stage that you had a return on capital that was higher than your cost of capital and it's sustainable, why? Because your company has a competitive advantage that's not going to fade. It's got a strong brand name. It's a protected market. It's got 1 billion users, and no other company out there has 1 billion users. That's when growth starts to matter. So I'm going to ask you, does your company have competitive advantages sustainable? If the answer is yes, I'm much more likely to let it grow for a longer period. So look at the size of your company, look at revenue growth in recent years, look at your competitive advantages, and answering those 3 questions will tell you whether your company is likely to grow for 2 years or 5 years or 10 years or no years before you put it into stable growth. Yep.
When I consider revenue growth in the last 5 years, should I eliminate acquisition?
I would take out acquisition, because that's obviously an easy way to get growth. So take out acquisition-driven growth if you can. That's sometimes more difficult than it sounds, because if it's embedded in your company, it's much more difficult to take out of the process. You see that Microsoft's trying to get back to being a growth company? By doing what? By buying Salesforce.com. Will that growth increase value? In fact, if they buy Salesforce.com, the minute after they buy Salesforce.com, their expected growth rate is going to be higher, right? Because they just bought a growth company in. But whether their value will increase as a company will depend on what? What they paid for Salesforce to buy that growth. It's the same question we're asking. What kind of investment did you have to get that growth, right? So you can buy growth, but if you paid a fair price for that growth, it's not creating any value. So here are my judgment calls for my company. So I'll take you through the process of why I used what I did. For Disney, they're an entertainment company in a business that's changing. Okay? Their excess returns are right now earning well above their cost of capital. Their competitive advantages, they have some of the most recognized brand names in the world. I'm talking about the Mickeys and now the Frozen, all those brand names that come in. I gave them a 10-year growth period. But the growth I'm going to give them is not 60%, it's going to be 6.8%, above the growth rate of the economy. But I feel pretty secure, given their competitive advantages, that they can create value from growth for a longer period. For Vale, it's a mining company. It's the 3rd largest mining company in the world. Its competitive advantages, it does have some low-cost reserves, primarily in Brazil, that it was endowed with. But as a large commodity company, I don't see where growth is going to come from. You're saying, but iron ore prices are going to, if I normalize my earnings, which is what I did for Vale, I can't even count on higher iron ore prices pushing up my value, because I've already reflected that. So you're going to see no high growth period for Vale because of the kind of company there. For Tata Motors, I gave a 5-year growth period. You know why? Not because Tata Motors in India has any competitive advantages that are going to allow it to grow. It's because of Jaguar Land Rover and the potential that might have for growth. So 10 years, 0 years, 5 years. And for Baidu, I went back to a 10-year growth period. I'll give away a secret. When I look at a company, here are my 3 choices for growth periods: 0, 5, or 10. No 4, no 7, no 6, no 8, no 35. And here's why. I can't finesse this too much. I really can't tell the difference between a 4-year growth company and a 5-year growth company and a 6-year growth company. It probably isn't going to matter that much. And I stop at 10 for a very simple reason. Are there companies that have grown for longer than 10 years? Sure. Can you name them? I can. There's Microsoft. There's, I can go. There's Walmart. There's IBM. What does the fact that you can name companies that have grown for long periods tell you about these companies? They're the exceptions rather than the rule. First rule in valuation is never value a company to already be the exception. Because if you do, what's the upside for you? Because the only thing you can have is a negative surprise, right? It's like being a Yankee fan and watching somebody run out to center field and say, there's the next Mickey Mantle. Only bad things can come out of those expectations. Or being a fan of an NFL team, watching a young quarterback come on. You can name Marcus Mariota runs on and said, there's the next Andrew Luck. Andrew Luck had to go through his own little growing pains, but you can't forecast out your company to be the exceptional company. So I stop at 10, and I think of whatever you do beyond 10 years as icing on the cake, that I deserve to earn as an investor, so 0, 5, or 10. So let me take you through my valuations of each of my companies. Okay? I don't like spreadsheet valuations. I try to kind of compress them into pictures. So this is a pretty complicated picture. So I'll take you, this is my valuation of Vale in November of 2013. I'll tell you what the stock price has done since. So you can, it's a cure for hubris to actually look at what stock prices have done. So to value Vale, here's the first thing I did. I normalized income by looking at the last 5 years. Keep that in mind, because as you pick apart the valuation, that might be one of the fatal flaws in this valuation. So I took 5 years. 5 years sounds like a pretty long period, right? The average operating income over that period was 17.6 billion. The average return on capital over the period was 17.25%. For the cost of equity and capital, I looked at the 4 businesses they were in, took a bottom-up beta, built in the cost. So the cost of capital I ended up with. And I did everything in US dollar terms because the cash flows are all in US dollars anyway. Cost of capital, including the country risk, is 8.2%. So here's what I did. I took that return on capital, normalized over the last 5 years, 17.25%. If I'm going to grow 2% a year forever, which is what I'm assuming here because that's, it's a stable growth company, they will have to reinvest 2% divided by the return on capital, 11.59% every year. 17,626 is their normalized income. 11.59% is their reinvestment rate. I've left the tax rate at 20.92%. Cost of capital of 8.2%. They're already a stable growth firm, so I've essentially used the terminal value equation. The value that I get for the operating assets is about 203 billion. Add cash, subtract our debt, value for the equity of 167 billion. Divide by the number of shares, gives me $32 per share. Stock was trading at $13. Seems incredibly undervalued, and I bought it. You know what the price is now? It was 5 about 2 months ago. It's still in my portfolio. I don't even look at it for I just act like it's not. That denial is often the best response to these things. What Vale? I don't see a Vale in there. No? It's now at 870. It's bounced back to 870. But it's still not 13. I've revalued it multiple times. The most recent valuation of a Vale is now down to about $11 or $12. Why? Because I've had to extend out. When I did my normalization, I've used 5 years, right? But if you look at iron ore prices, the last 10 years, you almost see a break with history. Iron ore prices used to be rock bottom till like 2002, and then China takes off, and iron ore prices take off with it. So when I normalize here, I'm still assuming that you're going to go back to the 2003 through 2013 iron ore price period. And if that's the case, Vale is an incredible bargain. But if you believe that normal year requires you to go back 25 or 30 years, then Vale starts to look less valuable. In fact, in my most recent valuation, I actually take the last 12 months where iron ore prices have essentially hit what they used to be in 2004, and I've used that as my normalized number. I've said, this is it. This is my new normal. I can't be hoping that I bounce back because there isn't going to be no bounce back. So my definition of normal has actually shifted as I keep watching what happens to iron ore prices, which is, I think, part of a broader message I want to deliver. Is there is this misconception that if you do an intrinsic valuation, that value is somehow frozen over time. It's not. It will change over time as your views about the market change, as your views about the underlying economics change. So it's still there. I'm hoping and praying it goes back up, but no, that's out of my hands. All I can do is make my best estimate of value at every point in time and hope that on average it works out. No. So that's a Vale valuation. For Disney, to get to my terminal value, I followed 4 rules, and these are 4 things I would suggest you keep in mind whenever you do terminal value. The first is, in terminal value, what did I say? Your growth rate has to be a growth rate forever, right? If you're telling me that you're going to use a growth rate forever, that growth rate has to be less than or equal to the growth rate of the economy in which you operate. And I use a very simple proxy for it that I've used before. That risk-free rate that I used to come up with my cost of equity now becomes my proxy for growth in the future. And here's the reason I do that. One is, if you look at the last 50 years, the best predictor of nominal growth in the US economy has been the T-bond rate at the start of every decade. It's amazing. It does better than any economist. Which is actually very depressing if you think about where T-bond rates are today, right? Because it's telling you that if you trust the bond market today, that expected nominal growth in the US economy is going to be pretty low for the next 10 years. The second reason I do this is because I want to keep my valuation from running away from me. And let me explain. One of the constant refrains you hear out there is that T-bond rates are too low. Risk-free rates are too low. That might or might not be true. I'm not going to argue the QE1, QE2, Fed effect. But if risk-free rates are too low, let's say you buy into that proposition, what is it doing to your cost of equity and cost of capital? They're also coming down, right? So you're pushing your values up by using too low a risk-free rate. So I'm going to do some pushback. If you use a really low risk-free rate to come up with your cost of equity and cost of capital, I'm going to set your growth rate at below that risk-free rate, because at least then what one hand gives you, the other hand will partially take away. What will cause your valuations to explode in today's market is use today's risk-free rate to get your cost of equity and capital, but decide to use a nominal growth rate for the US economy based on what you think is right. 4% forever. You're going to push up the value of your company because what you're assuming about nominal growth in your numerator and your cash flows is different from what you're assuming about those same rates in your discount rate. So respect the cap. In my case, I'm going to keep it below the risk-free rate. When I did this valuation for Disney, it was 2.75%. Second, I had to think about what Disney would make once it became a mature company over and above its cost of capital. Remember we talked about competitive advantages? I told you what I thought Disney's competitive advantages are right now. Owns Mickey. It's brand names that are recognized around the globe. I'm asking a different question here. I'm 10 years out now. Are those competitive advantages still going to be there? With Disney, my answer was yes. You see why? Because of the types of competitive advantages I'm talking about here are not going to fade in 5 years or 10 years. These competitive advantages have been there for the last 60 years. What makes me think that they'll somehow disappear over the next 10? So at the end of 10 years, I take the return on capital, which is right now 12.61%, and I lower it, but I don't lower it all the way down to the cost of capital. I actually lower it to 10%. Still above my cost of capital, but I'm making an assumption about Disney's competitive advantages forever. Think about your company and ask the same question. Do I have competitive advantages now? The answer might be yes. Will I continue to have competitive advantages at the end of 10 years? The answer might be no, because your competitive advantages might not be sustainable that long. Third, just because you're a stable growth company doesn't mean you don't have to reinvest. And to estimate how much I reinvest in steady state, here's what I'm going to do. I'm going to take my growth rate, which I set at 2.5%, which is below the risk-free rate, and I divide it by my return on capital forever, which is 10%, which means every year after year 11, Disney will be reinvesting 25% of its after-tax operating income back. I'm creating a company in year 11 that is a sustainable company, a company that actually is consistent with my assumptions about low growth, a lesser return on capital, and a reinvestment that reflects it. Finally, as I said, my cost of capital is going to drop to that of a mature company. It's not today's cost of capital. It's a cost of capital that I see for my company in 10 years. If you keep those 4 rules in mind, your terminal value will not run away from you. But you got to think about your company in year 10 as a very different company than the company you're valuing right now. And that's essentially the step in the process where you bring everything together. So you now have cash flows, next 5 years, next 10 years. You got a discount rate. You got a terminal value. You discount it all back. Pure mechanics. You get a present value, right? You're saying, what does that present value measure? It depends on what you discounted. If you did a dividend discount model where you discounted dividends back today, you're done. What you get as a present value of all those cash flows is your value per share today. If you did a free cash flow to equity model, you discount cash flows back, what you've essentially valued is the equity in the company. But if you did it in aggregate terms, if there are management options you might have given, this is your last chance to kind of take care of those. And I'll talk a little bit about what I mean by that. But if you have 2 claims on equity, the shareholders and the option holders, you got to figure out how much the option holders own of the company to figure out the value of the equity in the remaining shares. If you're valuing the entire firm, free cash flow of the firm, which is what I'm for Disney, what you've really valued are the operating assets of the company. You know what you haven't valued? You haven't valued cash yet, because income from cash is not part of your free cash flow to the firm. You haven't valued cross holdings in other companies. So if you're Yahoo, you know what I haven't valued? I haven't valued their holdings in Yahoo Japan and Alibaba. That's a big chunk of their value, and I have to value those and bring those in. So when you take cash flows of the firm and you discount them back, you haven't finished your valuation. You still have all these loose ends to tie up. Cash, you've got to add cross holdings in other companies, then you come up with the value of equity. And if there are equity options outstanding that you've given to managers, you've got to take those into account to figure out what the value per share is today. So here's my valuation of Deutsche Bank in 2008. My net income, my payout ratio, because it's only dividends, I get my expected dividends. For the next 5 years, I use the 5.5% growth, 4% growth rate that I estimated using my, if you remember, the return on equity and retention ratio for Deutsche. So those are my expected dividends for the next 5 years. Over those 5 years, I expect the cost of equity to be 9.23%. I discount the dividends back to today at 9.23%. So that's what happens over the next 5 years. At the end of 5 years, I make Deutsche into a stable growth company. I give it a 3% growth rate. This was back in 2008. With a 3% growth rate, they can afford to pay out a much higher portion of their earnings as dividends. How much more? Well, I assume that after year 5, their return on equity dropped to their cost of equity. Unlike Disney, where I assume that the competitive advantage will last forever, here I don't think that they will last forever. That allows me to come up with my payout ratio. That payout ratio is what I use to estimate what my equity will be worth 5 years out. In making that judgment, I use the 8.5% cost of equity beyond year 5. But to bring that terminal value, that value back to today, I use today's cost of equity. When you do valuation, there will always be these multiple costs of equity and costs of capital floating around. So right now you have a high cost of capital. In terminal value, you have a low cost of capital. Once you get the terminal value, to bring it back to today, you revert back to the high cost of capital, because you've got to live through the first 10 years to get to your terminal value, the first 5 years to get to your terminal value. That's my present value of my terminal value. Add those to the value of my dividends, I get a value for the equity of 49.7 billion. Divide by the number of shares, I get a value per share of about 105 euros per share. Thank God I didn't buy Deutsche at 89 euros per share, because it was within my band. Still, it wasn't cheap enough for me to jump in, because it's down to what, 40 something euros per share. But that's what a banking crisis will do to you, right? So that's the 2008 valuation. I used dividends, but as I said, I don't trust dividends anymore. This is actually my 2013 valuation of Deutsche. Stock had dropped to 35 euros from the 89. The value declined as well, and even with my free cash flows equity being negative, because I'm now using the regulatory capital approach, the value for equity that I get for Deutsche is 62 euros per share. So I've moved from the dividend discount model to free cash flow to equity, because I don't trust dividends anymore. But the process I'm using is still the same. Get cash flows to equity, I discount the cost of equity, I get a value for the equity. Tata Motors with the free cash flow to equity model, here basically I'm going to keep their return on equity and reinvestment rate at what it was in 2013, which gives me a pretty high growth rate, 24%. The cost of equity I used was a rupee cost of equity. Again, discounted back at that rupee cost of equity, the value that I get for the equity here, including the terminal, of just the cash flow to equity for the first 5 years, is 127 billion rupees. Okay. Again, same process, different company, but I'm looking at the cash flows left over after reinvestment, discounting in the cost of equity. At the end of year 5, I put them into stable growth. Right? And here, because I'm doing everything in rupee terms with a higher inflation rate, I get a much higher growth rate, 6%. But that higher growth rate has to be paid for. Again, same process. Get a value of equity at the end of 5 years, discount it back 5 years. I mean, I know there's a lot of numbers coming at you, but here's what I want you to think about. You have a high growth company, you have cash flows during that growth phase, you have a value at the end of the growth phase. That's what we're trying to estimate with all these numbers. And then we're bringing it all back to today, because we've got to pay that price today. and you're asking, am I getting this stock at a reasonable price given my expectations for the future? Of course, your expectations can be completely wrong, as they were with Vale. But that doesn't mean that you can't make your best estimates still at every point in time, and those estimates can shift over time. I won't even try to kill you with these numbers. Okay? But if you look, those are my free cash flows from earlier. This cost of capital that you see below the line was actually the cost of capital I computed for Baidu today with its existing cost, with its existing debt ratio mix. So embedded in here are all the numbers I used earlier in my capital budgeting for Baidu. Discount the cash flows back, there's my value for the operating assets, add cash, subtract out debt, I get a value for the equity. But here I'm valuing the entire firm. Revenues are changing, margins are changing, present value reflects what I think the value of the firm should be. Stock was actually trading. And I made pretty optimistic assumptions for Baidu. If you remember, the revenues I gave them are 154 billion. The value that I got is 150 yuan per share. Stock was trading at about 160 when I did this valuation. So just because you make optimistic assumptions doesn't necessarily mean that your stock is going to look cheap to you, because it depends on what the market's building in. And at least for Baidu, the market's building in even bigger expectations for what the company can do. So I'm going to close with the Disney valuation because it's a company we've worked on all through the class the most. And essentially, here's what I'm going to do to value Disney. For the next 5 years, I'm going to assume that Bob Iger is going to run the company, which I think is a pretty reasonable assumption. He's going to continue to do what he's been doing in the recent past. In what ways? He's going to keep the debt ratio at what it is today and a cost of capital at what it is today. He's going to continue to earn the return on capital he did last year. He's going to continue to reinvest like he did last year, which essentially means for the next 5 years, the company is going to be run as is. Beyond year 5, I put it into what I call a transition phase. And to see what I'm doing in the transition phase, go beyond to year 11. Year 11, I make them a mature company. Mature company, their growth rate goes to 2.5%. Their return on capital goes to 10%. Their cost of capital goes to 7.29%. More mature, lower growth, lower cost of capital company. Year 6 through 10, all I do is I move each number from where it is today to where I think they should be in year 11. So my growth is 6.8% for the first 5 years. To make it go to 2.5%, I go in linear increments from 6.8 to 2.5. My cost of capital is 7.81% for the next 5 years. To get them to 7.29%, I move them in linear increments. So years 6 through 10 are there just to adjust my numbers. That's all I do. I have 10 years of growth. At the end of 10 years, I determine a value. If I pull those numbers together, this is my valuation of Disney as of November of 2013. And I'll update what the price has done since and what the value has done since. Okay. Let me go below the line because every number on this page was actually a number I used somewhere else earlier in the class. Okay. So if you look at the cost of capital of 7.81%, here's where it came from. It started with a risk-free rate of 2.75%, which was the 10-year T-bond rate when I did this analysis. The beta 1.0013, I know you don't remember, but that's from breaking Disney down into 5 businesses and coming up with the bottom-up beta. And the equity risk premium of 5.76% came from geographically looking at where Disney gets its revenues. Those numbers give me an 8.52% cost of equity. To get the cost of debt, I start with the same risk-free rate. I use the actual rating for Disney to get the default spread, and I use the marginal tax rate of 36.1%. to get my after-tax cost of debt. My weights are my existing debt and equity weights. My cost of capital is actually the cost of capital we've been using all the way through this class as the cost of capital for Disney. My growth rate for Disney is 6.8%, but it comes from how much they reinvest and how well they reinvest. And those are the numbers that feed my operating income into the future. My reinvestment comes from that reinvestment rate, so that's what you see every year. Subtract the reinvestment from the after-tax operating income, you get the cash flow to the firm, discount it back at the cost of capital. And don't forget the big number at the end, of course. It's the cash flows beyond year 10. Gives me a value for the operating assets of 125.5 billion. Add cash. That's right off the balance sheet. Plus non-operating investments. You know what those are? Disney doesn't actually own Hong Kong Disney. Do you know that? The Chinese government doesn't let them own a majority stake in Hong Kong Disney. They own less than 50%. You think, so what? Because they own less than 50%, they don't have to show Hong Kong Disney numbers as part of their operating income. So I haven't valued it yet. When I did my EBIT and my free cash flow to the firm, I've left a big part of Disney outside. So now I have to bring that in. And I'm doing it on very limited information. I have the book value that Disney shows for the Hong Kong Disney. I have a sense of what they make, but I made my best judgment, plus 2.849 billion. Then there's a minority interest. You're saying, what is that? If you own more than 50% of another company, you're required to consolidate, which means you act like you own 100%. That minority interest is the portion of other businesses they own. It's not a big chunk of Disney, but it's like debt. I subtract that out, get a value for the equity. The options that I'm subtracting out here are the value of options that Disney has given its managers over time. Basically, I'm saying that's not my equity anymore as a stockholder. Divide by the number of shares, you get a value per share of $62.56. On Monday, after I go through what you turn in on your companies, I'm going to actually take this and put it back into the investment principle, the financing principle, and the dividend. Because everything we've talked about in corporate finance is somewhere in here, right? The investment principle drives the value, the return on capital. The financing principle affects the cost of capital. So I'll revisit this page on Monday, but please get your numbers into me by the end of this week, by Sunday, so I can pull them all together for the Monday class. Let's see you on Monday. Did well yesterday too. If it does, if you feel that one of the businesses is going to become a bigger part, then
I should review the bottom
if you really have a clear sense.
I'm doing Time Warner.
Unless you have a clear sense of what the business mix is going to be, don't even mess with it.
Instead of working now with the HBO thing, maybe that can grow a little bit, but
yeah, but unless you have a clear sense of it, don't bother. It's not worth it. Hi. You'd have to capitalize R&D. It's not as simple as just taking R&D and treating it as CapEx. In the spreadsheet, I allow you to capitalize R&D. And if you do that, then the reinvestment will reflect. All of R&D should be capitalized. But how quickly?